Doing business in Africa. You can't afford to be without Africa Investor.
Welcome to the German Climate Pavilion at COP28 in Dubai. Ambitious, just together.
Hello everybody, good afternoon. Thank you so much for attending and for making time in your calendars here at COP28 in Dubai. Also, thank you for joining us virtually, dear audience in our live stream. It's a great pleasure to have you with us here in the German Climate Pavilion. It's great to see you. So now the next hot hour will be, of course, about the hot topic of the role of the insurance sector in climate adaptation. And we're going to have a deep dive into that topic, a panel with participants from different sectors. We have guests from the insurance sector to discuss how insurance companies can really contribute to the climate adaptation. As we all know, climate change is a global challenge posing material risks to society, but also, of course, to the economy. And its consequences are becoming more and more, not just visible, but also apparent, particularly when we talk about the physical risk exposures and when we look into the increasing frequency of natural disasters, such as floods, droughts, and wildfires. And just recently, when we look into Europe, and I'm sure our panelists that will join us later virtually from the European Insurance and Occupational Pension Authority, she will have more facts about that figure, because the dashboard on insurance protection gap for natural catastrophes shows that currently only a quarter of the total economic losses caused by extreme weather and climate-related events are insured. I repeat that, only 25%. And that will keep us busy, of course, because it is the topic about insurability and the pricing of climate-related risks, which are becoming increasingly critical, not just for insurers, but also for practitioners, for policymakers. And if no countermeasures are or will be taken, of course, this protection gap is becoming wider and wider and is expected to widen. So just to give you a glimpse of what will keep us busy, our voices on the panel will focus on that in a second as well. Our main question will be really tackling how can the insurance sector support prevention and adaptation, or do we need to talk about adaptation to climate risks? So there will be different voices from different sectors. And the German Federal Ministry of Finance already started this conversation at the COP26. And now it's the continuation of this conversation here at COP28. We do have now a hot hour to debate, of course, what should be the focus of policymakers, of supervisors, of insurance companies going forward when we talk about climate adaptation. And of course, how does it all work together? How do we bring different perspectives together? What are the different goals? How do we combine them? How do we break the silos? And we hear that so often, right? How do we communicate better? How do we bring these different perspectives together? How can we talk about regulation and supervision, which are supporting the goal? And where are the limits, of course, of the companies, and what role has a policy instrument or have policy instruments?
Well, first of all, thank you for the invitation, and thank you, Günther, for saying everything that I would have said. So I completely.
I was the first one.
Yes, indeed. I completely concur with you. I'll give a slightly different view, really much, from an African perspective, looking at the sort of the infrastructure investment dynamic. And I think we, on the continent, we have to transform before we transition, and we have, a lot of adaptation-related issues, but we have, a very large infrastructure investment deficit. And if you look at the nationally determined contributions that we have, we know that that's, we have a slightly different problem and a slightly different priority, which is we're talking about $3 trillion worth of nationally determined contribution commitments or aspirations that will need financing. And I'll actually continue to move into the word investment. Because this underlying regulatory dynamic for us on the African continent is much more about a private capital mobilization issue in the very first instance. We've sort of been seen to be much more of a development project than an investable market, and therefore most of the things that happen, whether it's the insurance market, whether it's the infrastructure, equity allocations, whether it's the infrastructure debt markets, it's all suboptimal. So I think one of the things that we would start talking about in the very first instance is how do we change the mindset? I think the Secretary of State talked about was it COP26? Yes. Well, it took COP26 to get the private sector into this discussion in a meaningful way. So I think we really need to get the investment community into the conversation in a meaningful way. And because we haven't been able to get the investment community into the conversation in a meaningful way, the underlying regulatory environment is not conducive for capital to flow at scale. So all of these different insurable related opportunities need to be on the back of a market. And if you look in the African continent, it's completely suboptimal. If you take $3 trillion worth of NDC projects, if you're looking to de-risk a lot of these particular underlying opportunities, it's usually about a third, about 27% of that is usually some form of blended or de-risking instrument. So that basically means that just for African NDC projects, you need about 550 billion to 750 billion potential cover, or instruments that can actually de-risk that proposition. So if you look at, what is the capacity in the market currently, you're looking at African Trade Insurance Agency. That's a $400 million balance sheet. Everything it touches gets reinsured, and it's got a backstop from the World Bank. Not a real market in relation to, how things need to go in the orders of magnitude. But then people say, well, actually, let's just rather look at MIGA, Multilateral Investment Guarantee Agency, $60 billion balance sheet. That's not anywhere close to 550 billion or 750 billion, and 66% of that's from the private sector. I mean, just in terms of, how they actually get that cover. So I think we need to change the way that we think about this entire agenda. We seem to get pulled into conversations that are already sort of set in the frame, and then we're trying to do the best within a suboptimal arrangement. I think we absolutely need to be able to say, how can we get to the target? If we know the house is going to burn down in 2 years, let's not make a 5-year plan. And I think the strategy that we've really got to be able to do is address this issue of scale. And I think we have nice ideas, and I think we have nice instruments, but I think they're suboptimal, and I think that's why we're always going to be running around on the risk transfer or the risk sharing issue. And I think that's a key part of the problem. When you come to emerging markets and you come to the developing countries, data is key. If you don't know or understand that risk, of course you can't manage it, and that's where you start getting into some of these slightly emotive issues like does the public sector share the data that they have to crowd in private capital to do things like underwrite and ensure adaptation and mitigation, or do MDBs and DFIs perhaps keep that to their chest and potentially cost emerging markets and developing countries $15.6 billion each year of excess interest on their loans? So I think we need to take a very different approach to how we seek to enfranchise emerging markets and developing countries, both from the, as Gunther was saying, both from the adaptation, but also from the mitigation side. I think there is a new business model that needs to evolve. And I actually believe that there's enough liquidity and opportunity if only we can see it through a positive lens. So let me stop there. And thank you again, Gunther, for your opening remarks.
I'd like to come back to you, Hubert, because you were raising, and you come in after the comment of which. So where was the point where would you agree or disagree?
No, I agree very much with most colleagues here, and all colleagues here, but I liked what Butch had to say in particular about, look, we know the problems. Scale is the biggest issue. Why don't we start at scale and then, of course, bring in institutional investors to optimize our ability to be able to address the situation? And I think that there's not enough conversation around that. It's almost as if we want to dissect and sort of segment adaptation versus mitigation and have this conversation. Well, I think it's a different business model. It's interoperable in some respects, in many respects. We need to be able to bring the institutional investors in at scale in the most responsible and optimal way. I just wanted to then ask Butch. I mean, he identified the issues, those 5 or so issues, but what are the solutions if you were to look specifically at crowding in a responsible way, of course, long-term institutional capital to address these issues? And I was just going to give it the bent of as it relates to emerging markets and developing economies, because we've just got a loss and damage fund, and everyone knows that it's nice to have we need to have it,
but we need more also.
But the scale as well, we get so much into the technical detail, but then when it comes to the scale, I think we all go missing. So I just wonder how we can really, that's why I liked what he said in terms of about how we can really just focus on what really matters, not take a year to come up with something tiny, although the tiny has an architecture that we can leverage. So I'd like us to be able to get to that. How do we leverage this? How do we deal with the scale and in the more challenged parts of the world? That was really my
That is like a direct question to you.
Sure, that's an easy question. So I think one answer would be what I mentioned. Just to talk about the institutional investment, I totally agree with you and Gunther. I think globally, we know that the insurance industry has around 35 trillion, at least, in assets under management. The way that capital is deployed would have a telling impact on both adaptation and mitigation. So let's just talk about, let's say, resilient infrastructure, right? So one key to that is, one of the things for me is key is better disaster risk reduction on the ground. Insurers can only advocate for this. Governments need to take action. They're not the ones making decisions on land use planning and management. So if you're going to have trying to look into port or a bridge where you haven't taken into account sea level rise or other factors, that is not a good way to attract and crowd in institutional money if you haven't factored in those climate-related issues into land use planning and decision making. And what investor will go into that if you haven't really factored into that? On the insurance side, I'll give you one example that is very concrete, because UNAP is hosting the V20 Sustainable Insurance Facility, whose project office is funded by the German government through BMZ. So I'm happy to promote that, and my colleague who's leading that is actually here. And the scale problem here is one of the things we were wanting to address, which is micro, small, and medium-sized enterprises. If you look at many countries around the world, not only in the global south, but even countries like Italy, for example, MSMEs are the backbone of economies. If they are constantly shocked by climate change impacts, then there is a telling impact on development, right? Socially, economically, environmentally, etc. So our idea is, we know enough of the problem. We don't need more analytics and diagnostics on what's the problem in insurance protection for these. So our basic idea is that how can we have a template approach? What works in particular markets? There's been so much experimentation on parametric insurance or indemnity insurance across different markets around the world. What works? What doesn't work? And for those things that work, how can we actually apply that consistently across markets, because we know they already work, and achieve the scale that we need. And once we achieve scale, we can expand cover for other sectors and other types of perils, for example. These are some of the, and so we're working on a concept that one of the key problems on scale in insurance is that the whole transaction is very expensive. Particularly if you're looking at small and medium-sized enterprises, the distribution becomes expensive. So we're trying to work with banks, microfinance institutions, large manufacturing firms who want their supply chains to be resilient to climate shocks. So we want to provide them with climate insurance. And so we're creating a pipeline of projects, and we're now seeking whether donor money, private insurance capacity, or philanthropic money to insure those MSMEs in the supply chain. So, and we think we can bring that to scale. We have to show that we can scale that, because I agree, it's a scale problem. The other problem is a speed problem. A stitch in time saves 9. So as the saying goes. So if the money goes too late, then the economic and social consequences of climate shock would be much more severe. Mm-hmm. And this is why what Gunther said, parametric insurance over the last decade or so has become very popular, because it's trigger-based. If you exceed a certain wind speed or a certain level of rainfall, there's an immediate payout. And that's important. So I would argue, yes, scale is important, but speed to the most vulnerable is equally important.
Thank you, thank you. Gunther, I'd like to come back to you, and then Issa and Pamela. I see you both raising the hands, but I'd just like to just go straight to Gunther. How can you be an architect of scaling up and speeding?
Yeah.
As an insurer.
Just because we may actually miss a few key points, let me mention these key points first, and then I come immediately to the architect thing. Lots of the topics that we are discussing here would actually have an immediate solution step if we introduce a price of carbon globally. This is, we are in the game immediately. If we would start to think about subsidies, fossil subsidies differently, in the form of we subsidize those who are really in need and not the products, we have a second part of an immediate solution contribution. And the third thing is, as Hubert mentioned, if we were willing to use data that is already available, credit risk data, for instance, for certain emerging markets, if we would use those, and we have data pools where certain institutions are sitting on the pool but not providing, let's say, the insight into this pool, we have the third big step into the topics that we just discussed. But now, as we don't want to introduce a price of carbon, as we want to subsidize fossil products as we do, and as we don't want to share the data, we discuss, of course, other topics. Let's discuss the other topics. The other topics are indeed, how do we go, let's say, for insurers to really come in? And I do very much agree. I do agree. The topic is, of course, scaling certain solutions. Yes, of course, we need to scale certain solutions. But we mentioned now already the solutions, all of them. Or we did talk about we need to provide the risk insight so that people can really mitigate their own risk taking, manage their, let's say, own risks themselves. We need to provide the information so that there are certain forms of, let's say, physical risks taken out from certain assets. We have mentioned already these things. We talked about the product design. We need to pay out immediately. The trigger should be actually the incident and not the loss discussion. So I fear there is actually not so much to add to this other than that we indeed use this information and work on a scaled basis. There is not so much of miracles to this. And sorry for speaking a little bit too long. I do have the feeling that as we know all this, it's really interesting to notice that we go on and develop kind of concept papers on interesting things. For instance, we do know that we need, and that's also again very trivial, I'm sorry for this, it's very trivial, we need to reduce absolute emissions. Now we are getting together here by 100,000, and we spend time to talk about avoidance of emission and certifying removal. That's what we do. When we know we need to reduce absolute emissions, and we have all the means. We have all the means of that. Sorry, it's not adaptation, I know, but I just need to mention the point that we are making, we know the things, needs to really somehow be appreciated. And as we know it, then we may, and there you are right, the next level may be that at the next COP we really come together because we say, okay, we have really started to work on that basis. We have really used this knowledge and we implement on that basis. We are not going to another COP where we then have the discussion. Now we have again thought a little bit about this thing of emission reduction, and here is a good idea. Avoided emissions also need to be dealt with. No?
Again, are you an architect for scaling up then, as an insurer? How will you be an architect of scaling it up?
Yeah, the architect, oh, Now it's gone. You still hear me?
Yes.
Yeah, cool. Let's say the architect of scaling up is as I said, you don't develop new concepts, you use what we discussed here and provide this. Yeah, but that is what let's say a larger part of let's say the industry is attempting, but it really requires that a multitude of players come together. The data point that Hubert mentions is not a data, let's say a data pool that the private sector has access to. That's exactly the point. We want to have, let's say, the access, then we can talk about credit risk of emerging markets in a different form. And I'd like actually that you explain perhaps once again what we are talking about, so that there is the scaling no longer a game where only the insurance industry, where only the investors, where only, let's say, PSI or PRI can work. No, we need to actually work together on these topics. We need to appreciate that we know it, and then we need to follow through on it jointly. That's the scaling.
Pamela, you want to come in, and this is now your floor. So when we talk about scaling up and speeding up, and of course meeting here at COP28, what are your thoughts? You know, we have this conversation coming from COP26 now, COP28. So what is on the priority on your list and on your desk?
No, and I agree that we've been talking about similar concepts for quite a while. It's true. What I get from this conversation and where we are at is that we have to continue advocating for a global system approach, yeah? And there are three areas of importance, and I may sometimes disagree with what some of the panel members have been saying, but let's look at the first area. We talk about pooling of expertise, pooling of data. The Global Shield has been set up. And Günther, it is true that the insurance industry does not have access to all data, but also the insurance industry is a very large powerhouse of data, which it could share. And in particular, if we're thinking of insured losses arising from natural catastrophes. So we're very much working on that, also as EIOPA, in order to put together the overview in a structured manner of what are the insured losses arising from natural catastrophes. And then we're really talking about adaptation. I'm not talking maybe so much of investments, but that is something, the pooling of expertise, the pooling of data in the Global Shield, in freely open source accessible databases for policymakers, private sector, and public entities or stakeholders to actually have a look at what data can be used to improve prevention measures. And then we come to how do you improve prevention measures? And what I see, there are nationally defined contributions, there are national initiatives, but they still do not add up to a global solution. And I think what we still have to make, and how do we do that? I think we really have to have stronger commitments on aligning prevention and adaptation measures. And that is something really difficult. And I think there's the crux of the matter, because then you also know if we need to invest in these prevention measures, these investments can also be directed much more globally. And then I'm talking of prevention, but of course, as one of the members of the panel said, prevention measures also include mitigation, because then you reduce the risk eventually of having the damages. So I think we really have to have common agreements or common views on what we're going to invest in. And what has not been, I think, addressed in the panel yet is really the trust in the transition. And I think we really have to address greenwashing, because greenwashing really contributes to climate despair, as one would say. If you can't trust the net zero commitments of the industry or the net zero commitments of politicians, what are you then looking at? And this is really something we have to you can say walk the talk. I think we're all fed up with that, but we really have to go from policy to practice. I fully agree with the panelists. We have all the concepts on the table. The regulation is slowly getting into place. There's a lot of regulation. Let's not add too much to that, but let's start implementing and let's start drilling down what the key measures should be.
But again, Pamela, you said stronger commitments. And for me, again, with these buzzwords, I immediately dive in. So what do you mean by that? Give us a concrete example.
Well, it is very difficult to actually, as an insurance industry, I think the insurance industry has seen very big difficulties these days in committing globally to net zero reductions in their investments. And I think that is something that has hindered maybe also some action, but that is a commitment that has to be taken globally. So these commitments to really reduce investments, as Günther said, to really reduce investments in assets or in sectors that contribute to greenhouse gas emissions, these have to be followed up and these have to be scaled up. But I also understand we all are aware that these are difficulties. Are there the relevant investments? Can they be made? Are they available? Can they be scaled up? But of course, there are also reasons why some of these measures cannot be taken these days. And that is, I think, we have to make these commitments follow suit.
That's a direct comment, and then is Günther, please, and then is a comment.
I actually need to directly comment on this one because we do have the Net Zero Asset Owner Alliance. We are 86 members. We have committed to, let's say, Paris 2015, C1, no low overshoot scenarios. We also have published our third progress report, and in the third progress report, we have published that absolute emissions go down in the aggregate of our portfolios. So we are on the game, and we do scale. We do scale. Yes. What we, however, need to have is that more of the financial institutions join in. We are 86 now. We need to have more of them. And what I was talking before was when we have, and I speak, of course, because I was a member of the UN high-level expert group on net zero. When we have already a paper out there with 10 recommendations, and then there's a recommendation 4 that says, okay, how a transition plan looks like. We don't need another concept paper how to do a transition plan. We just take what recommendation 4 says, we develop the transition plan, and report back on how we do the implementation. But we should, and there I agree very, very much, we should, however, make sure that the integrity is there. We should not allow that others tell all of a sudden, I have a transition plan, and that thing has, for instance, not even a target for 2030. We should call out on those who say, okay, there's a transition plan, and so we clearly ask, okay, is it really covering what the high-level expert group of the UN has defined? And that's very important for the scaling. If we know what we need to do, we need to actually do it. And not say we do it, but then if you look into the details, you learn it's not done. We just say that we do it. Yeah? And scaling efforts are clearly there. They are there. More need to join.
Esther, why are we still in this, also in this phase of communication, what Günther just mentioned, we need more action. We don't need more concept papers. We don't need more ink on the paper. We need more action and support. Why are not more people and more insurers and more actors and stakeholders joining?
Naja, this you might better ask here the industry players, but I wanted to highlight a couple of 2 other points which I think were a little bit drowned in the debate. A small point, I think, Butch made, and then I fully agree. I mean, we need more people joining, but it's their decision. I mean, if you commit to these goals, which have been set out, for instance, by the UN, then we have the Net Zero Alliance, and we would wish that there are more people joining this. This is very clear.
But you as a ministry, you can also communicate, and you can also, you know, not force people to join.
That's not what we would do. We would always like to do that on their own back, because it's really their market decision to do so. But I wanted to come back to one small point Butch made, because he said something about investor education or consumer education and insurance literacy. I think that's a very important point, and that's also a global issue. I fully agree, and it's good that this starts taking up again a little bit more, because the OECD has started a process around that, which I think is quite important, because it's sometimes too much neglected in the debate. So I think that's an important point Butch made. And as I said, I mean, we believe that really market players have to do this by their own thing, and I think the point you made on transition point is really transition plans is very, very important, I think, because we think that's exactly a strong market tool by if a firm, be a financial institution or a corporate, real economy company, sets out its targets and market players don't think it's credible, it's helpful, it's not leading to the path of transition, then the market has a good tool to decide. So this is why we're very keen on working on that tool, because we think that is probably coming back. We have a lot of regulation, particularly in Europe, many of you might know, but we think that sometimes that tool would be a much better stimulus in order to take decisions by investors if they see these goals, and then they can make their own judgment call whether this is credible or not. And I think this is terribly important.
You want to comment on that, and then I have a quick look around if there's any hand signs. Otherwise, we go on with the online questions in a second. So Hubert, please share your thoughts and also bring in your perspective again. As you mentioned earlier, we also need to leverage private capital more and more and more. Which is a different question now, but maybe you can combine your 2 thoughts on that.
Yeah, no, it's. I mean, I think we're in the right place in terms of this conversation about the scale, the speed, and the action. And I particularly like Pamela's point about, you know, there is this global emerging markets database which pulls together all of the data on the performance of the loans from the multilateral development banks for decades now, and it is invaluable for us as the investment community to be able to assess the risk and really understand, you know, how to deal with the credit risk related issues for emerging markets and developing countries. And we've been asking for this, you know, data to be democratized for decades. And as I mentioned earlier, you know, I mean, from a development institutional standpoint, the mere fact of not sharing that data as sort of development partners is actually costing emerging market and developing country governments over $15 billion each year in excess interest on their loans. So really that data should have been made available immediately, and it's exactly what we've been calling for as the investment community, so that we can actually increase our allocations to emerging markets and developing countries, touching on both adaptation as well as mitigation. So I think that's really important. However, you know, we're all interdependent and interconnected in this sort of you know, area that we're working in right now. We're all here in Dubai for a reason, where we could be anywhere else in the world, because we genuinely care and we think that we can be part of the architecture for the future. And I think in that respect, what Pamela was saying, even on the GEMS data, we have to wait for that critical data to come from the multilateral development banks. We understand from Secretary Yellen and a number of other finance ministers and some heads of state that it's imminently going to be made available. But we as the institutional investment community have really come together on something called GEMS 3.0. Because the GEMS initiative, where we're now being told that imminently it's going to be made available, they've described that as GEMS 2.0. And this GEMS 2.0 is really just an agreement in principle of the owners of that data, being the multilateral development banks, to disclose the data to us as investors and to credit rating agencies and others to better inform investment decision-making process. But we believe, because of the need for scale and because of the need for speed, we need more than just disclosure. We actually need to create something which is much more of an asset allocation at scale tool. So we've actually started to build that in the form of GEMS 3.0, working with the industry to be able to get data from the industry that could be relevant in anticipation of waiting for the data from the MDB. So we're working with credit rating agencies, other institutional investors, and you caught my attention and imagination, Pamela, when you said that you're already you know, aggregating and bringing together a lot of this important data. So let's see how we can work together and create those unique data sets that can ultimately become asset allocation tools or data-driven instruments that can actually help us, you know, get to the scale and, you know, be able to deploy, you know, these instruments at speed. We think that in Africa and other emerging markets and developing countries, and in Europe and the US, the legal and the regulatory arrangements around how to invest in climate in these areas. That's why we have an Inflation Reduction Act. Everyone's trying to speed up things. Everyone's trying to be able to make things so that you can do it at scale. Similarly, Net Zero Industry Act in Europe. We're doing something very similar on the African continent. And we think that this is how we begin to integrate and have a different taxonomy. Everyone talks about the taxonomies around adaptation and all these things, but they rarely involve the institutional investment community's views in the final product. You know, we've had a number of conversations here with sort of different public sector groups, including multilateral development banks. They talk about taxonomies, and they're almost ready for distribution and public show. And you ask them which investors that these principles are supposed to crowd us in have you consulted? And it's the end product we are very rarely consulted. Then it's a surprise moment when we're not crowded in at scale. So I think we need to play our role. I think we are playing our role. I think we can all do better. We all need to do more. But I think this joining up, and I applaud what your ministry is doing, because the fact that we are here, Gunter and I, you know, shows your commitment to this area. And we'd like to be able to see how we can focus wholeheartedly on this scale and speed issue, because I actually think that the outcome could be very, very positive for all stakeholders and constituencies. Thank you.
Thank you, Hubert. I hear a lot of to-dos and your priorities. So I have a simple question. If you could call anyone in the world right now to fix maybe your top priority, who would you call? Because there's so many to-dos from so many perspectives, but just to knock it down again, who would you call? If you could call anyone in the world, you've got the phone number, just imagine that. Who would you call then? Who do you need to talk to fix your priorities?
Well, that's a very good question. I was thinking about that, the other question that you had earlier about, what would you ultimately like to see in the world? And I think what I'd ultimately like to see in the world is the trust barriers broken down. Because it's all of this delay, all of this lack of scale, all of this suboptimality and lack of speed, it's all founded in a lack of trust. If we could deal with the trust issues between the public and the private sector and the multilateral development banks institutions, we would not be waiting for 10 years for a GEMS database. Public sector wouldn't be complaining that private sector is only profit motivated. Private sector wouldn't be complaining maybe that the multilateral development banks have different priorities. It's the trust. That to me, if we can address this trust issue and align, because we have a common interest for humanity, that would be my answer.
Business in Africa. You can't afford to be without Africa Investor.